Good afternoon. We're not just the final panel before the awards, we're also the final panel before drinks. So the pressure's on us, yeah? Well, lovely to have this panel here. I think our topic is pretty interesting, but there's been a lot of discussion on data centers, so we will try and talk around the peripheries as well. But just as a quick backdrop, look, we've been seeing an increased level of activity in the digital investment infrastructure space, a lot of investment opportunities. We're seeing a number of tower cores, fiberization, of course data centers, but also on the fiber side in particular, it's a new dynamic around FTTT and what we call FTTDC, right? So fiberizing data centers and not just towers. Multiple greenfield opportunities, brownfield opportunities, and increasingly consolidation and mature M&A. On the tower side, there's a bunch of processes going on. We know that Philippines in particular is seeing a lot of activity. Fibers, there are carve-outs happening. There's a lot of complexity in fiber carve-outs, which we discuss as well. And on data centers, I think enough said, but we will touch upon that as well. In terms of the capital release, right? So we're seeing investment opportunities. We're probably seeing a lot more filling in of the gaps in portfolios. We're seeing a bit of FOMO, late catch-up, but there are enough opportunities there to even fill the portfolio gaps. But more importantly, we're starting to see a reallocation of capital happening. We're starting to see funds now looking to reallocate capital, start to show some returns to raise the next fund. And you're seeing a bunch of these activities in the market right now with various different investment objectives, right? Which has its impact on valuations, time to exit, and a strategic imperative to show some monetization. In terms of the panel, we've got a very interesting mix here of Manjeet to my extreme left, Head of Infrastructure and Digital Investment Banking at BAML. We've got Dearman, who is a investor in data centers, and we'd love to hear from him on the build-out and what he's seeing in terms of pipe and constraints. And we've got Jacqueline, who is sitting on the advisory side on the legal aspects of deals, but is seeing deals both buy and sell side, and as well as distress, as we were discussing. Yeah. So just kicking it off, let's start with Manjeet there. What is driving this continuous ramp up, Manjeet? We're seeing a fair bit of activity. We're seeing investment strategies evolve, right? So helpful to understand what you're seeing in terms of the recent trends. What is changing? Are people being more selective, or is it still, land grab?
Yeah, no, thank you very much, Gautam. I think a lot of what's driving today is the demand side. We've seen that from a lot of the discussions today. I think what's driving it from the investor side is this recent period of low rates that we had, where a lot of capital was raised, but then the door shut relatively quickly for a period of time, where people didn't deploy. Not necessarily in digital infrastructure, because that was continually pushing with growth after growth of different sectors that we'll talk about today. But what we have seen is the evolution of investors, these big guys, the private equity guys, rather than being sort of traditional private equity as we used to think of them, and traditional infrastructure investors, they've shifted to being more in that sort of fund management, capital allocators type of a framework. And so they look to deploy where they can deploy. And that means it's not necessarily in a traditional pure equity sense that they will do. If they can do deals where they can support a capital structure in a data center platform, they'll do so. If they can have some downside protection, just given the risk profile of a lot of the newer businesses that we're seeing, whether they be CoreWeave or these other types, they look at it from a debt perspective, they look at it at an equity perspective, and they look at it somewhere in between, and they're finding pockets of capital within that sphere, as well as family offices and the like who come in and follow. So what we see is a bit of an evolution of how capital is being allocated to the sector, and that's, you know, helping, I think, deal with the level of capital that is required to deliver on the promise of everything we're talking about today.
Understood. And I think on the capital side, you know, we heard Robin this morning, and you know, that's 24 billion Aussie, 16 billion US buyout, right? Behind that, there's a $10 billion capex requirement for the business plan that Blackstone's bought into, right? And as we were discussing earlier, the bank market in Australia is pretty much tapped out on this deal. So when you're looking for 10 billion of growth capex, most of it actually committed, which helps across APAC. Where do you get it from?
Well, I think we've talked about it, but there's there's the infrastructure funds, obviously. There's the family offices, which particularly in our part of the world and really being centered around Singapore and Hong Kong and these parts of the world, is we're seeing a proliferation of those family offices. And everybody likes to say that I'm a small investor in OpenAI, or I'm a small investor in, you know, NVIDIA or something of that order. So there's a quote-unquote sexiness about having some exposure to this sector. And so we have seen it in the fundraising, where we see family offices coming in to support these infrastructure funds as capital allocators. And we've also seen it through some direct investments where, you know, there's countless wealthy family groups that we meet around Asia, and they say, talk to me about data centers. I have this land here, I have that land here. Who's going to help me build it? And that's a hard marriage to sometimes make, because just having land is not the be-all and end-all. And you know, this is probably a good segue into how Diamond has been evaluating opportunities across the region as well.
Yeah, David, so you nodding violently and putting agreement, so let's hear that. Are you getting families coming in, unusual investors coming across?
I think we get both a combination of unusual investors and unusual land providers. I think anyone who has land today that feels appropriate to be a data center feels that the best use of that land would be a data center, because that's the highest and best use of the land. Now, there's obviously lots of other requirements around that, about power, location, proximity to people who might want a data center, proximity to people who might build it or ship equipment to it. But we do get regular inquiries from people who have land in very strange places, going, I've got power, here it's all about power, and I've got a great power generation facility here. Picking remote location. I'm not going to pick one because I might be giving away trade secrets and making people excited. But like, would you like to build a data center there? Like, fantastic, it's a great thing. But no, because it hasn't got connectivity, it hasn't got proximity to the population center. So I think, you know, it is about capital, it's about money, it's about power, it's about water, it's about green energy, but it is still, as several other panelists have talked about today, it's about proximity to those tier 1 locations. Even in the US, where you see build-outs around the country, and Europe, where you see build-outs around the continent, you still see these massive tier 1 markets that are growing faster than anywhere else. You look at Virginia, 16 to 20 gigawatts of power. That's more than Asia outside of China is deployed today. So you think of that. I don't know if you've been to Virginia, but it's not that great, you know.
It's very suburban, but it's setting right at the heart of connectivity, right?
Yeah.
So yeah.
But and it's there because that's where cables are, that's where you can get power, that's where people are. You've got a critical mass, it's easy to build there. There's finance institutions that are comfortable with the risk there. The whole market is just comfortable. Whereas secondary markets are very different.
I understand. So it's attracting all kinds of people who can monetize wherever more assets there are, right? But I think there is such a view around growth and the opportunity, and I think what we just heard from structured research is showing that it's just starting, right? And in ASEAN, it's just emerging, right? Philippines, Indonesia are still underpenetrated. I want to bring Jacqueline in, particularly on the earlier topic, Jacqueline, around financing, capital flows. How do we get access to that capital? Are we going to see some new instruments coming into Asia from the US?
Yeah, absolutely. I think what we are seeing definitely is an influx of creative capital structuring, obviously driven by both a need for different capital structures at different levels, whether it's OpCo, HoldCo, mezzanine, and the like. We need to allow for both upside and downside sharing, and as well as to allow for different risk profiles of investors coming in. Obviously, the risk profile of an infrastructure fund that's funding a platform is different from the risk profile perhaps of a small family office. But what we are seeing is a lot of creativity being exhibited, coming up for grabs, and a lot of downside protection as well. So far, we were talking and joking about the distressed M&A space. That's not obviously at the cycle of the data center business at this point in time, and we don't expect that to be happening anytime soon. But what we are seeing is both a series of very large-scale M&A in terms of acquisitions, consolidation in the sector. A lot of data center platforms are building out and acquiring brownfield and greenfield assets in order to build scale, and we would expect that as that grows, which obviously drives the need for capital expenditure and capital structuring and investments, you would expect further consolidation down the line in the sector. Now, what we see in Asia is obviously that there are almost all banks are very heavily involved in the capital raising process at this point in time, and a lot of the funds are very actively involved as well. And we fully expect that as Asia grows, there will be more and more need for additional creative modes of financing and capital raising to come in, simply because the demand is absolutely great in Asia. But of course, the local laws around security, around enforcement, and around enforcement of rights and regulatory requirements are obviously different in each country. And so you're going to need savvy investors to actually go in and understand each of those risks as you go through it.
Yeah, and I think in particular the ABS market, right, which is a key catalyst for the US data center business, right? And I think we're waiting for it to come here. Possibly Australia may be the first market, but that's the capital release valve we need, yeah?
Yeah, that's absolutely the latest that we, at least at Millbank, we've been incredibly active doing the securitization of data center revenues in the US. I think in the past year that has absolutely exploded. Perhaps 18 months ago it wasn't there, and in the last 12 months it's been massive. We just did the securitization for Asia, up here in Asia. We do think and hope that that will be a possible revenue stream for data centers out here. And I think we're just basically hoping, we would expect that to take off in the next couple of years, particularly as the market for investors becomes more sophisticated and understands the product, and particularly as scale improves in Asia.
Manjeet, I want to talk about deal complexity. Right? I mean, we are still seeing carve-outs. We're going to see, for the first time, fiber carve-outs happening, and they're complex, right? Complex in terms of anchor tenants. The telco finds it hard to let go. Want to keep an ownership going. What's the right capital structure? How does that impact telcos? Waiting up top. And it's probably the first of the fiber situation we're starting to see now. Yeah? We've had towers, data centers seems less complex, it's more greenfield. But how are investors assessing and addressing deal complexity, particularly in a carve-out structure, but also for first-time deals in this part of the world?
Yeah, you're right. As it relates to fiber, this was always the thing that was held most sacred by any telecom operator. It's the core of the network. It's fundamentally what every aspect of their business runs on. And so there's always been a reticence to really entertain the harebrained ideas of carving it out. But there have been some good examples, particularly a lot of the learnings have come from Europe, and increasingly also we're seeing in the US, more on the greenfield build-out side, and some of them have had success and some not as much. What we're now looking at, and there's been a few transactions announced, one recently in Australia in terms of an actual network carve-out from one of the large telecom operators there into the hands of an infrastructure investor. And we're looking at things right now in the context of Indonesia as well. The fundamental complexity of those deals comes from the meeting the requirements of who is the largest off-taker, which is essentially the telecom operator, and giving them the comfort that it will be safe in their hands, and if there is a problem, there is a manageable way and an acceptable way for a recovery to take place, and that it won't impact the actual customer-facing aspect of their business. There have been countless examples of service disruptions and whatnot, even whilst they own their own network. So that's not a thing that doesn't happen. But when you get regulators and you get politicians asking, why is this not fixed, or why is the network down, you're not going to be able to really buck past and say, well, I don't own that, it's that person, because they're your customers who are being affected. And so having mechanisms to ensure and having comfort as a telecom operator that the commercial framework that you're negotiating with your infrastructure provider as they become is critical. And it takes so long as you think about these long-term off-take deals and how are you going to think about what your business might look like in 10 and 15 years. To boil that all down into a document that you're going to sign today is a scary prospect, and that's why there hasn't been so many of these deals anywhere in the world. But as Asia does, we are leading at the forefront, and we're going to, find our way through.
Can I ask you a question? Sorry, I'm very sorry in your role, but obviously what some parties are thinking about is that the appropriate way of thinking about it is to use the MSAs that we use for tower transactions, and you use that as the governing document for a fiber carve-out deal. Do you think that's going to be helpful in this case?
Depends on the market. Some markets probably have some more complexity to them and regulation related to it. I would say it has to be an MSA plus, because there's a lot more complexity with the fiber business relative to passive tower infrastructure. Not to be disparaging to those documents, it can be quite complex as well. Yeah, but I just think that you're in another level of complexity with fiber deals.
Yeah, and also, I think telcos are still finding out what they have. They mostly did not know that in terms of what they have in data centers, on top of brownfield situations. And in fiber, we're finding that diligence is very hard, because it takes a long while for them to really ascertain what's in the ground, what's lit, what's not lit, and that's causing a lot of delays in processes. But actually deal complexity. Right, share your perspectives across digital infrastructure, and are you seeing a bit more of acceptance, or are you seeing the complexity going in a different direction?
It's a good question. I think let's take this on from subset to subset. I think on the data center transactions, we're really at the start of it, because like a lot of platforms right now, it is a mix of greenfield and brownfield. A lot of platforms are starting off with greenfield and now are starting to consolidate. So the complexity comes actually from the financing, which are large scale and relate very much to the structural security that banks can accept over the transactions. And that, while there's some level of complexity there, I think we expect that those transactions are getting done. They're getting done in India, Indonesia, Philippines, Malaysia, and Singapore, obviously, and we expect those to continue unabated, as the capital raise continues. We've talked a lot about the capital raising structures, and those obviously will be attendant to the needs of the various investors. Right now, they're very deep-pocketed investors in the large data center platforms, and so we've seen that complexity will arise as it goes forward, but perhaps not to the same level that we've seen in some of the others. But when it comes to fiber across Asia, that's extraordinarily complicated. Whether you're talking about terrestrial fiber or subsea fiber, both of which are extraordinarily in demand in Asia and very much low in stock. So as we're talking about terrestrial fiber carve-outs, whether it's fiber to the home or otherwise, those deals are, as Manjit pointed out, incredibly complex because of the regulatory overlay, and also because of parties involved. I think a lot of these fiber to the carve-out transactions are potentially looking at strategics or financial sponsors coming in, and that obviously will have an element of consideration around how to operate those companies, because they will not be passive necessarily, and that's the risk. And then when we talk about towers, I think now we're seeing a range of consolidation, potentially deconsolidation, and that's going to be another interesting route. But obviously the tower market is extraordinarily mature, very successful, and so I think we've seen a huge amount of interest. The Philippines was the latest in the tower market, obviously, and has been extraordinarily successful there. It goes to see whether other jurisdictions will similarly follow in terms of transactions. We have not seen that as much in the other Southeast Asian jurisdictions, but it goes to see, I think the tower market is only going to grow in importance. And obviously, as the players in the tower market evaluate their options going forward, you would either see a range of further consolidation or perhaps even more capital taking on the cards.
Gotcha. Dear man, let's talk about a different aspect of data center, right? And let's weave in investors as well as capital flows. I mean, there appears to be a massive build-out happening, particularly in India, right? And a lot of the top-tier data center operators talk about supply chain management, right? And it's not just build and they will come, they have come, let's build, right? There also appears to be, and we heard some earlier speakers also building it up. How is that ecosystem working, right? In a way, it's the picks and the shovels of the data centers, yeah? Are you flat out? Is there enough resources, talent? Is there enough capital? And are you seeing a differentiated capital going into the data center businesses versus what's going into stakeholders like yourself?
Okay, I think there's about 20 questions there, so let me see how we go. Look, I think if you look at the supply chain, and it's going to depend on the country, but you look at markets like Japan, which are obviously a peak data center market, or peak infrastructure market for Asia, there is a significant shortage of general contractors. So, the population of Japan is declining by, let's say, 750,000 people a year. And those obviously, by nature, generally older people, generally have come out of manual labor. These are the people that are not being replaced in the construction industry. Not all of them, obviously, but the construction industry is shrinking whilst the demand is growing. And so you've got constraints in the contractor market, you've got constraints in supply because there is demand everywhere. So anyone that's building generators or transformers or switches or CPUs, GPUs, disk drives, anything to do with technology, they look at their market and go, this much is going to Japan, this much is going somewhere else, this much is going somewhere else, this much is going to certain customers. So the supply chain and management of it is incredibly important. And when you hear operators like the Air say, we build quickly, it's because they manage their supply chain incredibly efficiently, because they buy in bulk and they forward purchase. When the lead time for a generator today in Japan from a Western provider was over 2 years. So if you're starting today, you find your land, you go, well, it takes me a year to sort that out, I've got power, that might take up to 5 years. There's a long lead time in this process. So people like ourselves, people that are developing significant amounts of property, we sort of pre-order, we have land banks, we pre-order power, we pre-order long lead equipment. And that's even before you start getting to financing at some point. And so supply chain management is incredibly important. And that's Japan. Korea, similar challenges. Australia, slightly different challenges. And then you look at different markets around the region. They've all got elements of the same challenges. And it used to be, you buy land, you would build a data center, everyone will turn up. Now it's like you need land, you need secure power, you need secure water. You need to make sure you're not building it in a place where people are going to complain about it. You need to have a general contractor, you need a customer, you need financing, you need an awful lot of things to go right in the project, to deliver that project on time, on budget, and to specification. And that is what's differentiating the winners and the losers in the market today. And to be able to do it consistently around a region or globally is incredibly challenging. And I think that's where you're starting to see the differentiation in the market, because the end customers, the hyperscalers, the GPU builders, if you like, are going to people they're comfortable with who have a track record. And that's the secret behind organizations like AirTrunk, like other leaders in the market today. And that's why they continue to grow their businesses.
The other question was around investors, right? So, from your perspective, since you may have to sometimes go on spec as well, right? Where is that capital flowing from? And is that a challenge or?
So we are a GP. We have a number of LPs behind us who we raised capital from. We raised a fund in 2022, which is our first VC fund. ESR has a strong track record of raising funds across various logistics and technology deliveries around the region. We also have other investors as well who are behind the DC business. Some are more comfortable with spec than others. And I think it again depends on the market. Many investors will be happy to build on spec in Japan. But if you turn up and say, I'd like to build on spec in Vietnam, they're going to say, maybe not today. And as Morgan from PGIM talked about earlier, it's about that risk reward. Everyone's very comfortable in Japan, the demand will come. In Vietnam, it will come, but it will be slow. And so if I want to build and get out and stabilize my asset and sell it and take advantage of it in 3 to 5 years, I'm going to invest it in Japan or Korea or Australia or Singapore or even Hong Kong. But if I'm not so sure, then Vietnam.
Capital release, are we in a phase of capital deployment? And are we seeing infrastructure investors staying the course, right? Or are we starting to see the beginnings of capital release and LP calls saying, okay, let's see, what you got for us, right? We need to see some returns if you want us to come back to your next fund. Where are we in that journey, Manjit, and then Jacqueline?
Yeah, I think it does vary by asset category. Personal view is that data centers, because of the growth that is so insatiable, the role of some of the earlier movers who built substantial platforms globally, the capital requirement is somewhat getting away from them if they just hold on to all of their earlier built facilities. So you have seen instances where people have put them into REIT structures. These are stabilized assets. They have put them into private REIT structures. There has been a few instances of stabilized assets that have been listed into REIT structures in Singapore, for instance, as well. And so it's about looking at your back book and looking at your front book. Your back book can, if you monetize it, either through a private REIT structure or a listed REIT structure, it can help fund the growth of your front book. And the role then of the platform is more of I will take the development risk. I know the customer, I know how to build the data centers. I will extract a certain return. It may well be in the teens because I'm taking the development risk. And then what will happen is I will sell that asset once it is stabilized to a more longer term stable insurance type of capital, which has a return requirement of 6-7%. I'm sort of making numbers up a little bit, but the profit is made from developing it at the 15-ish% level, making that return and selling it for a cap rate, so to speak, of 6-7% or even tighter in different instances. And so that kind of pathway for how capital moves from one pocket to the other and what the role of the platform is sort of evolving. Some people, some commentators have talked about the fact that AirTrunk was growing so much that it was getting almost too big for somebody to acquire, and even quite large for capital markets to absorb. Now, I don't agree with every aspect of that, and there was clearly an outcome there that it's the beginning of the next phase for that business. But people need to be wary around being most efficient with what they're good at doing. Do that and move these assets on so that the cycle can kind of continue and you're moving it through where that investor pocket values that dollar that you're delivering most closely. For a pension investor, they will love a stabilized asset that just keeps on giving for 10, 15 plus years, but that won't suit growth PE, and so they have a role in different aspects of what the business does.
Yeah, I totally agree with you. I like the phrase that the growth at the moment is insatiable, because that's exactly what it feels like. But you're absolutely right that the way that gets presented as a growth and investment opportunity is very much now going to depend on what aspect and how that's going to be presented to different levels of investors. So I don't think we're yet in capital release stage, simply because there's still so much capital that's required for the business. But I do think that what each platform is looking for is a stable capital structure that can continue to support the growing needs of the business. And to do that, it is likely that they're going to have to find different types of investors to come in. So, not just growth PE, which obviously looks for the multiple and returns on equity, but also on banks, which can also accept a leveraged return. And then further going forward on perhaps, as we talked about, even the securitized assets perhaps, which would allow for pension funds and insurance fund strategies to take that instrument onwards and provide for a stable rate of capital as well.
Can I just add? So, I think growth is insatiable in the right market. And so I think you do have to pick the right market, but equally, and to your point, I think there is a different sort of investor that looks at investment, particularly in the data center space, on a project basis versus a platform basis. And I think the value we're seeing out of an air trunk is the platform. It's the operating model, it's the consistency, it's the McDonald's of the data center. So, please, no one ever quoted me on that. And the reality is that those investors are looking for that sort of return from the operating revenues as well. And the sort of business model we're in, which is more LP fund-based, is very project-based. Everything's specifically tailored around project here, project there, project there. And those investors obviously just want to stabilize that asset and generally get out of it and put it into a stabilized vehicle after that. I think the platform investors have a much more long-term view of it, which personally, having come from an operator background, I can relate to more. And I think we're going to see more and more consolidations as people create platforms. And as we've seen in towers, we're starting to see in fiber. I think we'll start to see that in data centers as well. Today, there are very few global data center operators that are running platforms consistently around the world. I think we'll see more.
Absolutely. I think the next wave of activity in data centers that we look to expect is going to be on the consolidation, right? Because there are lots of independent people. We saw 3 platforms being built out just in Malaysia, right? That's going to come. At what stage does that come? We've got to look at it. You mentioned one thing which was interesting. Growth is insatiable in the right market. Tell us a market where growth is at a discount right now.
And where growth is at a discount.
But it's not insatiable.
Okay. I think, with the greatest respect to the market, Hong Kong. Whereas historically Hong Kong was seen as a tier 1 market. Around the time of COVID and around the time of the unrest in Hong Kong, and I was living in Hong Kong at the time, I think the market lost a bit of love for Hong Kong from a data center perspective, and part of that was just this concern around it that the growth wasn't insatiable, that the economy wasn't doing so well, that there was concern around it being part of Greater China. And I think that has caused some of the data center investors to look at Hong Kong and say, maybe not for us today. And equally as much the hyperscalers aren't there in as greater way as they have been in the past. And I think it's still a highly growing market, it's just perhaps not insatiable. So let's be clear, there is no data center market in Asia that isn't growing. And there's something, everyone complains about competition in the data center space. I think we'd all rather work in an industry where there's competition than one where there isn't. Because if there's competition, it's because it's growing and there is an opportunity to be seen. That exists in Hong Kong as much as anywhere else. But I think the growth will come back, but at the moment it's not quite as insatiable as perhaps a Tokyo or a Sydney or an India.
So certain markets are on steroids.
Some are on steroids, some are just growing quite normally and will still be big kids when they grow up,
Gotcha. Jacqueline, I want to bring you in on learnings, right? Possibly from fiber, right? In the US and in Europe, where it's been a bit more of bust and boom, yeah. And how do we learn from that, right? And where did those things go wrong? and how do we make sure that it's a bit more measured and it's a bit more, well, it's robust, but it's measured in terms of growth and investment?
That's a really hard question because there's so many lessons to learn from fiber. Fiber has traditionally been a market which obviously all the capex like data centers are all heavily skewed to the front of the transaction based on a market demand and expectation that you would basically be able to sell the capacity at a certain rate over a certain period of time for a certain length of time. And I think where fiber has consistently struggled is that that market demand has either been too robust or too rosy up front, and therefore, if it was leveraged in terms of its capex on the front side, it didn't meet its business plan, and therefore it struggled somewhere down the line. And so I think that's obviously a cautionary tale for any business, getting your demand cycle wrong. But fiber has always been an issue. Fiber, I think the other thing is fiber found it difficult to sell large scale, and like the data center, could potentially have a large percentage of its capacity taken up by just a couple of hyperscalers. Fiber, oftentimes, you had a business plan that had a percentage taken up by large customers, and the remainder was perhaps taken up by more bespoke demand. And it relied very much more on a shorter term lease model. And so I think the demand side of fiber was always hard. That coupled with, if it was a telco business holding it, they needed it at cost. And so there was always pricing pressure as well on that. So you had the unfortunate mix of high capex upfront, and then just recurring operating expenditure, and perhaps a lot of times the demand side, the demand was, business plan was too rosy upfront, and they couldn't actually pay the debt in time. So what we've seen is we've actually been doing quite a bit of distressed M&A in the fiber space, where operators have taken on distressed debt and enforced on the assets, and therefore getting a discount on the assets. And in that realm and in that sphere, with that playbook, it's an incredible asset because, as you said and as you pointed out, fiber is one of those things where it's so hard to get it in the ground. But once it's in the ground, it's just a matter of time before it fills up. And once it fills up forever. And the cycle takes a long time to repeat. So it's always just that price point of how to get it in the ground and the work that's associated with getting it in the ground and then pricing it correctly. So I do think the learnings from fiber are probably, it needs a better cap structure up front, something that can be much longer term. But obviously longer term capital, it tends to be, from a financing perspective, tends to be project debt.
Right.
And project debt requires clear offtake on day one, and fiber doesn't have that.
Correct. And there's also the concept, the problems rather, of multi-builds and overbuilds, right? So you've got to really go to the right market structure, given the longevity of your investment, right? So
Exactly.
Okay, I guess I don't know how we're doing on time, 5 more minutes, but maybe one last question for the panel around the portfolio concept of digital infrastructure, right? Does that really exist, right? And what I mean by that is, is an investment fund or an infrastructure investor saying, look, I'm a digital infrastructure investor, I need to have this allocation towards data centers, fiber, and towers, and then I need to connect the three, to fibers, for example, right? Is there a portfolio approach? Is there a risk of too much exposure on one versus the other? Not just geographically, right? But within the digital infrastructure spectrum, or are we seeing investors launching different platforms for different verticals and saying, let's go, right? And we'll diversify within those geographically. Yaman, let's start with you.
Wow. Again, you've just given me all the multi-choice questions. But I think, as a GP, as opposed to an investor, we tend to get people investing with us that are looking at us as a real estate investment rather than a digital infrastructure investment. So I think they see data centers quite realistically as a real estate investment, predominantly, in much the same way as they would do logistics. And so we get more often than not compared to logistics than to towers or fiber. Having been in the fiber business before in a previous life, I it is a similar business in terms of the capital outlays, but as Jacqueline was saying earlier, the outcomes have generally been different and the competition is different. Whereas data centers absolutely look like real estate. They feel like real estate, they generally lease like real estate. The risk profile looks a bit like sort of office or logistics or tech parks. And the way of getting out of it is consistent. So I think investors will continue to look at data centers in that realm, unless of course they're investing in operator platforms, in which case you're now looking at it as digital infrastructure. The investors in an operator like an AirTrunk or an Equinix or a Digital Realty see that as digital infrastructure. But at our level in the industry, they see us as real estate. It depends where you invest. Depends where you invest.
Gotcha. Ajit?
Yeah, I think it's different characteristics of each of the asset categories that you talked about, and there's a few, some are more suited to growth-oriented investors, but you can't say that holistically. You could say that towers are stable, cash flow generating assets, sure, but in markets where there's a lack of tower infrastructure, it necessitates a lot of capex and growth to continue to build out towers, so it actually flips to being more of a growth investment, and you'll never just be in harvesting mode from the cash flows coming from towers. So it depends on the market and the actual assets that you're looking at as to how it fits into what it is that ultimately your LPs or whoever you're managing money for or investing your own money for. What is your objective? Is it yield? If it's yield, then stabilized data centers or stabilized towers. Sure, if it's about growth and then ultimately selling a platform, having made those development style yields throughout the journey, then it can be growth markets for towers, growth markets for data centers, and growth markets for fiber. The risk profile again is different because you only have a handful of customers with data centers and towers, but you have a myriad of customers typically as it relates to fiber, as Jacqueline alluded to. So I think, people pick and choose where they are on the risk spectrum, and because they are funds, they may have specialized platforms that say, I'll only look at edge data centers, and that will be my edge platform, and I won't roll into hyperscale at all. And we are seeing a little bit of that differentiation as we see what the investors are doing across the region. The region is not homogeneous, and neither are the asset categories themselves.
Jacqueline, you get the last word.
I personally, and I don't proclaim to be total expert the way you or Majid are on this, but I don't think I've seen end-to-end platforms yet. I think I've seen particular platforms which are more siloed. You've got a data center platform, you've got a fiber platform, you could have a towers platform, but I haven't seen somebody that's tried to integrate completely and provide a single set solution. Well, except for a telecom provider who's done that, and obviously they're now in the process of actually carving out those for greater growth. So I think that was an old model. I think we're seeing the new model as being more standalone infracos and working that through. So.
Yeah, I would agree with that, because I think it's the world of specialization, and capital has become very selective where they want to go into, right? So the hybrid use of capital, let's say, I'm a tower company. I was talking to a big tower company in Indonesia, and Steve, the CFO, was here, and he's speaking tomorrow. And he said, look, we own hundreds of thousands of kilometers of fiber in Indonesia. And when the tower usage goes down, and we're a large telco, the investors don't give us any recognition or value for having fiber, which is very stable, right? So the investor is not really rewarding hybrid model. So I think that's one way to look at it from a public market perspective. But thank you, excellent discussion, and thank you for all the inputs and the thought-provoking debates here.
Thank you.
Thank you very much.
Thank you.
Thank you.